Welcome to Alpha Insights. I'm Nathan. Markets are closed today for Martin Luther King Jr. Day, so while U.S. exchanges are on pause, this is a great moment to dig into the building blocks investors use every day: financial statements. With me is Marcus, market historian and fundamental analyst. Marcus, great to have you.
Thanks, Nathan. Nice to be here. Even when markets are closed, the fundamentals never take a holiday.
Let's start simple. People hear financial statements and they think math homework. Walk me through what each statement actually tells an investor.
Sure. Think of the three statements as three views of the same business. The income statement, sometimes called the profit and loss, shows performance over a period. Did the company sell more, and did it keep a healthy slice of that revenue as profit? The balance sheet is a snapshot at a moment in time, what the company owns, what it owes, and the equity in between. The cash flow statement reconciles the two. It shows whether reported profits actually turned into cash and where that cash went.
Okay, income statement first. What are the key line items an investor should focus on and why?
Start with revenue because top-line growth answers whether demand is growing. Then cost of goods sold, that's the direct cost to make the product or deliver the service. Subtract that and you get gross profit and gross margin, which tell you about pricing power and production efficiency. Next, look at operating expenses: research and development, selling, general, and administrative. High R&D can be a sign of investment for future growth. High selling and administrative costs might mean the company is inefficient. Operating income and operating margin show core profitability before financing and taxes. Finally, net income and earnings per share matter for shareholders, but treat them carefully. Watch for one-time items and changes in share count.
So growth plus margins equals health, generally speaking?
Exactly. Consistent revenue growth with stable or expanding gross and operating margins usually points to a healthy model. If revenue is rising while margins sink, that's a signal to dig in. Is competition cutting prices? Are input costs rising? Or is the company spending more on customer acquisition?
Give us a quick real-world flavor. How would you think about Apple here?
For Apple, you'd separate hardware from services. Services typically carry higher margins. If revenue growth is coming from services, that can expand overall gross margins. So look not just at aggregate growth, but at the mix driving it.
Now the balance sheet. What should listeners zero in on there?
On the balance sheet, focus on liquidity, leverage, and asset quality. Cash and short-term investments are obvious. Inventory and receivables matter because rising inventory relative to sales can signal demand weakness, and growing receivables can indicate customers are taking longer to pay. On the liability side, check current liabilities and long-term debt. Ratios help. The current ratio equals current assets divided by current liabilities, and quick ratio removes inventory from the numerator. Leverage measures like debt to equity and net debt divided by earnings before interest, taxes, depreciation, and amortization give you a sense of solvency. And always remember industry context. Utilities normally carry more debt than software companies.
Inventory and receivables, those are the sneaky ones that trip people up?
They can be. A retailer with inventory piling up probably faces discounting risk and margin pressure. A business with stretched days sales outstanding, that is, slower collection of receivables, can face cash strain even while showing profits on the income statement.
And the cash flow statement is the tiebreaker?
Yes, the cash flow statement tells you whether accounting profits become real cash. Operating cash flow shows cash from the core business. Investing cash flow shows capital expenditures, acquisitions, or asset sales. Financing cash flow shows dividends, buybacks, debt issuance, or repayment. Free cash flow equals operating cash flow minus capital expenditures. That's the cash available to pay down debt, return to shareholders, or reinvest.
What are the red flags people miss on cash flow?
A big one is profitable companies that generate little or no operating cash flow. If net income is positive but operating cash flow is repeatedly negative, that could mean earnings are driven by non-cash accounting items or aggressive accruals. Watch for one-off boosts from working capital that aren't sustainable. Heavy capital spending can produce negative free cash flow temporarily. Tesla is an example where the big factory buildouts create cash strain, but can be acceptable if operating cash flow improves over time.
You mentioned ratios earlier. How should listeners use them without getting lost?
Group ratios into four buckets: profitability, liquidity, efficiency, and leverage. Profitability ratios are gross margin, operating margin, net margin, and return on equity. Liquidity ratios are current and quick ratios. Efficiency covers inventory turnover and receivables turnover. Leverage looks at debt measures. The trick is trend analysis and peer comparison. One number in isolation is rarely meaningful. Compare to the company's history and to industry peers.
What are the common mistakes new investors make when reading statements?
Reacting to a single quarter is the top one. Short-term noise can come from seasonality or one-time items. Another is ignoring the footnotes. That's where revenue recognition policies, contingent liabilities, and material accounting judgments live. Over-reliance on non-GAAP metrics without understanding the adjustments is dangerous. And finally, ignoring cash flow. Profits on paper mean little if they don't convert to cash.
Listeners love quick rules. How often should they review a company, and which metric matters more? Earnings per share or free cash flow?
Quarterly reviews are standard but focus on major events, earnings releases, mergers, capital raises. Between earnings, set alerts for material changes. As for EPS versus free cash flow is often the more reliable signal because it shows actual cash generation. Use EPS alongside free cash flow for a fuller picture, but prioritize cash.
All right, Marcus, wrap it up for our listeners. If someone pulls a company report after this episode, what's the checklist they should run through?
Quick checklist. 1. Confirm the revenue trend and where growth is coming from. 2. Check gross and operating margins for stability or deterioration. 3. Look at operating cash flow versus net income to see cash conversion. 4. Examine working capital trends, inventory and receivables, for early warning signs. 5. Assess leverage and liquidity through simple ratios and compare to peers. And 6. Read the footnotes for one-offs and accounting policy changes.
Perfect. Before we go, give our listeners 2 or 3 takeaways to remember.
Sure. 1. Read the 3 statements together: income, balance sheet, and cash flow. They work as a system. 2. Prioritize recurring operating metrics and cash flow conversion over single-period accounting items. 3. Use ratios and trends and always check footnotes before making a judgment.
Great stuff. Thanks, Marcus. And to everyone listening on this holiday, use the time to open a recent quarterly or annual filing and run that checklist. That's Alpha Insights. I'm Nathan. We'll be back before markets reopen.